You're gonna want to watch this one to the end. The disaster begins now. Ooh, terrible earnings recession. Oh, FUD. Level 99 FUD. Folks, we have to be real about what we could be facing here. Almost everyone on Wall Street is expecting a nightmare. An absolute nightmare of margin compression. Almost across the board, we expect that 80% of all companies will have margin compression, and that only the top 20% of companies won't have margin compression. And unfortunately, Wall Street is really gloomy because remember what we talked about at the beginning of 2020? We said, look, and I believe I could have been one of the first in this finance community. I'm not trying to pat myself on the back. I'm just trying to say one of the things I warned about in January was if we have 2 quarters in a row of negative GDP, we'll have a technical recession. Now, that doesn't necessarily mean that we're actually in a recession. It just means technically on paper we're in a recession. And what the concern then becomes is if people believe we're in a recession, do they pull back and go, whoa, we got to pull back spending. Oh, no. And at the same time as people pull back spending, do poorer people then start piling on and taking on all of the loans? And we have some data now that suggests maybe we are being too gloomy. Maybe Wall Street is too concerned. And one of the most important things for you to know as an investor is what is your Achilles heel? See, if you're all cash and you're shorting the market right now or you're out of the market, you got to ask yourself, what's the bull thesis that you're missing? If you are in the market, you got to ask yourself, what's the danger that you're missing, right? And so we cover a lot of both sides, but one of the things that we really have to look at is what's going on with consumers. And I'll tell you, there's some stuff about consumers that's actually, well, I'll let it speak for itself. Look at this. We've heard that borrowing has skyrocketed over the last quarter. We actually see that here. Total consumer credit skyrocketed, one of the highest levels we've seen before. I've talked about this in other videos. I've tweeted about it. But look at this. When we actually get this Bank of America breakdown of all consumer credit card new accounts, what we actually see is average FICO scores are 770. So this actually means people with more of an ability to repay their debts are borrowing. Well, what does it look like if we go to consumer autos? Oh man, average booked FICO score around 790. Even though the volume for autos is down, the people still borrowing right now seem to be those who have more of the ability to repay. And this is really interesting because this morning in our course member live stream, we went through the JP Morgan earnings call. We did a little bit of research on Bank of America and some other looks into the consumers, as I generally like to do. We even did some dominoes just to see what's going on with the consumer. And one of the big things that we noticed with JP Morgan is they were warning us that, hey, we're seeing the lower income segments start seeing their deposits go down, and their excess savings might be totally gone by the summer of next year. In fact, as we kind of approach the summer of 2023, we might see not only the lower incomes, but the middle incomes and the rest of sort of the income tiers will start seeing all of their extra savings go away by the middle of 2023. So JP Morgan's kind of given us this heads up that like people could still have spending power between now and the summer of 2023. So even though we feel like, hey, we're technically in a recession now, we actually might not be yet, because consumers are still spending like crazy. And remember that our negative GDP numbers were not actually driven by a lack of spending. They were driven by a negative trade report on GDP. So when we actually look at the consumer isn't driving a recession yet. And so that could lead us to a potential upside surprise in earnings. Consider this. Jamie Dimon and JP Morgan tell us nominal spend is still strong across both discretionary and non-discretionary categories, with combined debt and credit card spend up 13% year over year. Now, sure, 8 or 9% of that is probably inflation, but they say cash buffers remain elevated across all income segments. With spending growing faster than income, though, we are starting to see a decrease in deposits on those lower income segments. So then this goes back to something else that we started talking about in Q1 of 2022. that maybe where we need to focus is actually those businesses that appeal to the higher income demographics who are potentially going to ride out this entire recessionary drama. I mean, consider this. Look at the people borrowing right now, the people functioning in our financial markets. Average credit score, 770 for consumer credit cards, 799 for consumer vehicle lending. We go to mortgages, 768. Go to home equity lines of credit. These are smart people, by the way. These are people who hopefully saw my videos in January of 2021, where I said, now's the time to break the piggy bank of your home equity line of credit. Get a refinance appraisal at a high as long as you can afford the payment. Open that credit line. Look at that. Smart people. High credit scores, 792 credit scores, not to correlate smart people with higher credit scores, just saying smart people opening those lines of credit as long as they can afford them, right? So that way they have the opportunity to use that potentially to go buy the dip in the stock market when pain comes later. So we're actually seeing right here, unfolding in front of our eyes, the rich again getting richer. They're taking advantage of the fact that they can borrow on their homes at appreciated values and potentially take this money and go buy the dip in the stock market. If they need a new car, they can get it. It's not the lower income demographics that are doing it. Now that's actually really important because the higher credit score, the lower likelihood of bankruptcy and foreclosure or repossessions. Sure, it's easy to go, oh, clickbait, repossessions are through the roof, foreclosures are through the roof. Sure they are when you compare to the pandemic when there were none going on. But what are we seeing? Airline demand through the roof. It's the poor companies like Carnival Cruise Lines that are getting screwed. It's the companies without pricing power like Nike, because everybody can generally buy Nike, right? It's those that also appear to that lower demographic that are getting screwed. They're the ones in the earnings recession. Now, of course, everybody also already got their new PC. Everybody also has their new tablet. Look, I still haven't even opened this, okay? This is ridiculous. I still haven't opened these iPads, okay? We just have too much stuff now. And so it's no surprise that now we're seeing goods inflation, core goods inflation has decelerated from over 8% to 6.5%. Services inflation has gone up to about 6.5%, so we've kind of met. Now we're hoping that inflation can inflect down sometime in Q1 of 2023, maybe. But then again, we've had a lot of hopium that inflation would go down by the end of this year, and it hasn't yet. So don't get me wrong, there are still downsides if inflation persists. But, and quite frankly, the consumer being strong might contribute to inflation, which is a problem. But when we look at earnings of quality companies, higher tier companies, especially companies that appeal to a higher income demographic. For example, Tesla or Enphase, as long as home values are high, or Generac, as long as, again, home values are high. Anything home related requires home values being high. As soon as home values start deteriorating, you'll see that deteriorating as well. But there's a reason you're seeing Tiffany, right? Louis Vuitton, right? These luxury brands actually seeing more sales rather than less. Airfares, people traveling to Europe, we're seeing more of that rather than less from the people who can afford it. So, what does that mean? That means if we are bears on this market and we believe that this earnings cycle is going to be absolutely terrible, then maybe segment which companies you're looking at. For example, Domino's. When we actually consider inflation, their sales are probably down 10 to 12%. But maybe we look at some of, again, those more luxury-related businesses, like, hate to say it, because I don't really think they're luxury, but I do think they're middle to upper class, American Express. Look at the businesses that are still hiring, not laying off. Who's hiring right now? Tesla's hiring for their factories, and American Express is hiring because they're opening cards like they've never opened cards before. And American Express is probably your top tier in terms of FICO scores. So it's kind of interesting. If you want to stay away from real estate, you look at American Express and you look at Tesla right now. Now, we know the chip market has gotten destroyed, and China creates some real issues, especially for companies like NVIDIA and AMD, when 25% of their revenue goes to China. Only 10% of Taiwan Semiconductors goes to China, right? So there's a potential opportunity. But there is some real potential that this earnings season won't be as bad as expected. And so if there is a word of caution to folks who have potentially a lot of bearish bets, be prepared for potential upside surprises on companies, not only with pricing power, but potentially more of those luxury good based companies. Because what I'm seeing and what I'm reading on Wall Street is a lot of doom and gloom, but when we actually start going through the reports that are coming out, again, either the airlines or the banks, they're not telling us to expect the worst just yet. Now, that's not to say, hey, it's time to go to the moon again. Oh, the stock market's green. Take out margin, pile in. Stay out of margin. Get away from debt in this market. You still want to be careful. If you get green rally days and you're in margin, use those as an opportunity to get out of margin. But boy, oh boy, I'm seeing some good things out of the beginning of these earnings calls and these consumer reports here, especially what we see here on borrowing from Bank of America. Here, by the way, is that chart on core goods and services. You can see how core goods inflation has come down. Services inflation is still rising. But if we can get services to come down, especially owners' equivalent rents, that could be good. Take a look at this other retail report, also separately out from Bank of America. Spending from higher income shoppers remained strong from their October report in September, for September, right? Based on their October report, which was reporting on September. In Q3, the 125,000 plus income cohort spent 10% more on luxury than last year. Upper middle class is still spending. Now, spending by those who make less than $50,000 fell 13%. But look, somebody making $50,000, you have to ask yourself, what are they not buying? Well, they're generally not Apple customers. They're generally not iPad customers. They're generally not Tesla customers. They probably don't own their own homes, so they're probably not Enphase or Generac customers. They're probably not customers of American Express. Now, Atlanta, which has like a median income of like $36,000, it's really, really low. Look at this. Reportedly, Home Depot is putting up 600,000 square feet of space around some of their properties in suburban Atlanta for sublease. And that's despite strong consumer demand year over year in sales at Home Depot. But in Atlanta, they're like, uh-oh, red flag. This is the kind of stuff that I'm paying attention to for HouseHack, because I need to make sure that when we buy real estate for HouseHack, it's in an area that's not going to go bankrupt, that's not going to die. And remember, if you're an accredited investor, join me. Okay, join by the end of October, and you'll make sure you get, it's up to 60% in warrants. It's like 60% call options. So you put 100 grand in, that's like getting 60 grand worth of call options totally for free. Now read the prospectus for the details as to how all that works. But anyway, this is a big deal, especially as they see vacancies going up in this area. And we're seeing clothing sales soften, with department store spending falling below 2019 levels. Well, again, who likes to go shop at Macy's or some of the lower tier things, like let's say a Nordstrom Rack, right? Nordstrom Rack. Generally, you're under 100K demographic, right? So these are places to stay away from. These are hints to pay attention to. Now, look at this here. They still talk about luxury, though. Our global luxury goods team reported a slower September as well, but positively highlighted that luxury revenues remain robust as in Q2, an impressive feat given the global context. It's interesting. All right, really incredible. So, what does this mean? Well, what this means is we are, whether we are or are not in a recession, we are going through what I would call the tale of two cities recession, where poorer individuals, households making under $70,000 a year, unfortunately are going to get reamed by inflation and energy costs and higher goods costs. Those making over $125,000 a year are still spending. They're still borrowing. They're the ones responsible for more borrowing, which doesn't mean we have a debt crisis. It just means that they're like, yeah, whatever. All right, we got to get through this. We're going to keep spending money. And so I want to be investing where those people are spending money. Pay attention to that. That is potentially money. All right, folks, thanks for watching. We'll see you in the next one. Bye.